Accountants of Australia, hello. My name's Lee Davidson, and I'm the General Manager here at Finance House Group, a specialist finance broking division created to help you and your clients with all aspects of their finance needs. Today we're here to discuss the link between equipment finance and increasing core accounting revenue, and I'm joined by my senior broker, Lachlan Spence, senior relationship broker and relationship manager here at Finance. Good afternoon, Lachlan.
G'day. Hi, everyone.
Good stuff. Thank you for joining us today. We're about to head into some slides which talk around core accounting revenue and how it can help us grow fees and help clients with applications for equipment finance. Now, before we do that, it's important to realise just how big the Australian financial sector is. I'd like to just share some numbers with you, and that's that financial services is the biggest single employer for Australia, and it generates an income of $1.9 billion to our GDP each and every year. Now, according to Treasury, that's likely to continue to grow at 0.9%. And the reason that it's likely to grow at such an amount is because we have an increasing population, we have increasing inflation, so house prices and equipment prices continue to grow, and also we have an ageing population where more people are taking part in that finance sector to actually enable us to continue to grow. Now, with that in mind, the average business customer that you have will have typically 2.4 pieces of equipment on their depreciation schedules. Typically, they're pieces of equipment that these companies have actually financed. Each and every business that you have, that you look after, will need equipment to be able to function their business. Now, we're going to get into a couple of scenarios today just to discuss just how you can use finance to grow your core accounting revenue. We're going to move on to types of equipment that we typically finance before looking at some scenarios to be able to do so. It is worth pointing out that 80% or so of the equipment finance referrals that we receive each and every day, each and every week, typically go through the finance system pretty quickly. Now, the reason that's the case is that banks have automation, fintech really helps with algorithms and certain sort of direct authorities to get those through. And the assets that we typically place that go through quickly are trucks, vans, and vehicles that are used for businesses. We also finance some unusual assets at times. Things like gym equipment can be particularly difficult and complex to place, but we have skills and expertise in being able to help that type of client in that type of industry. And the reason they can be difficult is generally to do with resale value and the like. Other pieces of equipment that we regularly help with would be machinery, CNC machines and the like, and occasionally we get some unusual assets such as aeroplanes and other heavy goods. Now, as I mentioned, 80% of all of the applications that we typically see day in, day out go through the system pretty quickly. So what we're going to look at are instances where we need to help the client with your expertise, your guidance, and what you know about the client to be able to get through those 20% of applications that sometimes need extra help. Now, why is it that 20% of applications sometimes struggle or sometimes need to get through this credit manager's view of what the application looks like? As brokers, we know that the good and the positive that buying the piece of equipment can have, and you know the good that it will have on the bottom line for your client and how it will improve their business. But we've got to convince the bank's credit manager on the merits of that application. So how do we do that in the 20% of instances where we need that extra help? Well, we often reach out and request freeway cash flow forecasts from you, the accountant, to be able to assist in getting those applications through. There are many apps that you can use to be able to generate these, and they typically take somewhere between 4 to 8 hours, depending on the complexity and the number of entities involved in the company's business to be able to do that. That's very much core accounting work and very much billable time. And many of the accountants that we work with pass that fee and pass that work on to the client to help them support and to help them grow that business. Is that something that you do? Is that something that you've got set up at the moment within your accounting firm to be able to assist those clients that need that type of work and that skill set to be able to generate that type of revenue? Regularly, we hear from accountants who don't use Spotlight or Futurely and rely upon their own skills and whereabouts to be able to create Excel formulas to do so. But what we like is work that can help you generate revenue, that helps your client's bottom line in a speedy, efficient and process-orientated manner. Now, Lockie, if I cut to you for a moment, you've regularly been helping recently some clients with different types of assets at different stages of a client's life cycle and business cycle. Tell us around how you work with the accountant and some of the ways that you do so to be able to generate a positive outcome by way of application.
Yeah, there's been a handful of referrals and new clients from a myriad of our accounting partners around the nation for businesses that have been in different stages of their life cycle or a different financial profile. So that may be asset-backed, non-asset-backed, inside of the first 2 years of their startup, or a new business, new entities, SPVs and the like that have branched off larger operations with existing facilities. A couple of issues that come with that is a security understanding and an overall statement of financial position of clients, giving the bank comfort in and around those. There's aggregation issues between lending across a number of different entities and things like that in the group, and understanding where, when, and how to place the relationship with different lenders to make sure that the deal sings along through credit nicely. Critical to all of this is understanding the real nuts and bolts of how the business makes money. And if you're talking with regard to equipment financing and asset financing specifically, more often than not, we see equipment finance or asset financing providing new machinery, new equipment that has a direct impact positively on a client's ability to grow and build revenue and ultimately onto their bottom line as far as profitability goes. And so what that entails is working very, very closely with the accountant to devise, as you said, three-way cash flows, but also financial models that demonstrate the utilisation rates, the contracting, the projects that these pieces of equipment go out on, and how that revenue relates and falls back into the business. Because we need to prove serviceability based on the information now, but also based on the information in the future. And that is critical to have, it is critical to have a certain degree of integrity to those numbers, to those assumptions, that only comes from an accountant. That only comes from somebody that intimately knows their client's business and intimately advises their client's business at the various stages of their life cycle. And so what's happened, we've been able to positively come to the purchase of probably a dozen pieces of equipment for businesses at all different stages of that life cycle and for all different needs. And a difference, depending on the application and the profile, that is usually on somewhere on a journey that's between one-off applications for one piece of equipment finance, all the way through to limits or lines for ongoing purchases and non-flexibility and more agility, depending on where they want to go with their business and what's on offer.
Fantastic. Some really good examples there. And I guess that as finance brokers, it's really important for us to understand that client, where they've been, as well as the journey, because that can have a huge impact on which lender we approach to be able to actually place that client's application, because it's generally about speed to market and speed to approval that sees these deals often get over the line. Now, moving on to our next slide and talking more generically around other ways that we can help. We recently was speaking to an accountant about fuel tax credits and how using the depreciation schedules, they've been reviewing some of the client's assets that they have to do a post-settlement review to see if actually all of their clients that they look after have been claimed for fuel tax credits. So for those of you that are viewing now and viewing live, certain types of assets can receive fuel tax credits, and those typically sort of are companies that are GST registered, and there's certain types of equipment that typically go off grid, go off road for a period of time, and that logbook of how often they're used and how often they're used off roads can actually be used to claim a credit from the ATO website. Now, this is very much about building a process again that can help you generate refunds and concessions for your client that can actually then generate you fees for accounting work, but also get clients more money back than what it would cost them to actually do the work. So for those of you that are maybe not aware of the way the fuel tax credits work, any asset that the clients had and they can demonstrate that it's been off grid, off road for a quarter, can actually go back in time 3 years to see that refund time and actually be able to claim that. Lockie, from your perspective, the type of assets that you're aware of that can be used for fuel tax credits and refunds that we've funded in the past include?
A huge amount in mining services industries and construction industries, drill rigs, horizontal borers, excavators, moxies, all of those, even your smaller track loaders and things like that, I believe is eligibility is governed by, as you said, being off-road, use of business and over a GVM, gross vehicle mass of 4.5 tonne.
Fantastic. Yeah, and we've even had some clients recently who are in the haulage industry where their vehicles are sitting in warehouses, so off-grid, but they've got the engine running to keep the machines cool, and that's things that we can actually look to help support you as accountants claim back fuel tax credits for your clients. So the point here is very simple. Have a post-settlement review process about your client. What piece of equipment have they recently funded? Or even in tax planning time, look at depreciation schedules for the types of equipment that they have to see if you can help them generate refunds. And obviously there may be a fee component in that to help do that, but hopefully the refund outweighs the credit and the work that you're putting in. A nice easy suggestion there that was brought to us recently via one of our partners here in Western Australia. Now, the last slide that we want to talk around is very much in and around limits versus one-off applications for finance. During the time of year that we're in now, April through to June, we know that many of you spend time tax planning for your clients. But is finance part of that tax planning conversation? This year, more than any other year, I'd like to stress the importance of talking to your clients about limits and a maximum amount that they're looking to borrow for equipment over the next 12 to 18 months. The reason I see this as being critically important to your client's success today, tomorrow, and into the months ahead is because of the shortage of equipment there is in Australia at the moment. Vehicle prices are at an all-time high. Used vehicle prices are going to surge in value again over the next 6 to 8 weeks, largely due to what we've seen on the East Coast, with more floods, more vehicles being written off. The delay in getting new vehicles into Australia means that used car prices are actually increasing. Due to some of the issues in terms of getting goods here due to COVID and other issues, yellow goods, equipment, machinery, it's not coming into the country as fast as it once did. Now that means that there's a bidding war out there for good pieces of equipment. Now by doing the work now in tax planning season and looking at your clients' depreciation schedules for the types of equipment they have, understanding what that business is looking to do over the next 12 to 18 months, it's very possible for you to put in place limits to do the work once, as opposed to reactively needing to do that work when a client comes to you to say, hey, I need to buy a vehicle, I need to buy some machinery. Limits in place means you're doing the work once and you're doing it strategically, and you can then build that conversation into your tax planning season. Lockie, in terms of limits and what we're looking at the moment, what sort of clients are you talking to, and what sort of conversations are you having with accountants about how we get limits in place?
The conversations generally in and around the deeper understanding of where the business wants to go, what the horizon looks like, and what the market that they work in looks like. In Western Australia, we see a lot in the mining services and construction industries, and we can see that understanding logistics restrictions, supply restrictions, and skilled worker restrictions means that the reliance on equipment is growing in the more macro market. What that means is that businesses need bullets in the chamber to be able to take pieces of equipment and new assets out of the market to get them in and increase their capabilities and increase their scope that relates directly to their core business. Limits are a critical weapon in that. So what is required is that close relationship with the accountant to provide information, understanding and advice as to what the business looks like with that limit in place, how it's going to capitalise on them, market penetration, understanding who the clients are that this business serves, and why there should be support for an ongoing rolling facility to allow this business to grow strategically. The other side of it is what the accountant offers that transaction is, rather than a business going one-off, I'd like a limit and I want to buy equipment when I want to and pay it off quickly and keep going from there. It provides the lender or the financier comfort that the limit and the growth of that business is going to be sustainable. And that is critical, because we can see, specifically in WA, as we have a boom-bust economy, that you're not often going to get rich in the current boom, but you set yourself up to get rich in the next boom. And so it's understanding that, so that no business is put outside of its comfort zone, no business is put out of its ability to repay the debt and operate profitably, and everybody has the ability to make ends meet, which provides longevity to the client's relationship with the accountant, with the lender, and so the world goes around. They are critical things. Technically or specifically, what that comes down to, again, is ongoing management of the client's taxes and portals and those positions, up-to-date financials for at least 2 years running, BASs up-to-date and paid, things like super guarantees, income tax, all of those are clear, as well as then the supporting documentation in the form of three-way cash flow projections, assumptions, and utilisation rates and items like that would support what we're saying is going to be the projected revenue.
So in summary, how would you say that putting a limit in place helps the accountant help the client?
The work, as you say, is done once or done annually, largely speaking. The accountant's critical to getting it over the line, and the limit or the facility itself allows the business to be agile. So if a piece of equipment comes up that increases their capabilities or increases their ability to serve an existing customer, that provided it fits fairly straightforward parameters that are set out in the facility, they can go with a bullet in the chamber to turn that vehicle into their own asset and get it out into work. That means that business is growing, that means that business is producing revenue and still being able to function profitably, provided obviously all of those markers are hit. More so, the business or the client and the accountant are tied at the hip in that advisory relationship, because it's critical to understand the scope of works and how the business is going to grow sustainably with that limit in place. And everybody benefits from the relationship going long term with integrity and with accuracy as we future-proof businesses, asset growth and expansion down over the horizon.
Fantastic. And look, another scenario there is that one of our longest serving partners out of Queensland regularly talks to their clients about limits. And, over the last 12 months, one of those clients who has a limit in place has just gone out and replaced 10 vehicles. So it generates referral income from finance back to the practice, just money just turning up in your account week in, month out for a referral piece of work that you've done back in April of another year and reviewed year on year. So it's a fantastic way to ensure your clients are always finance ready. We often talk around keeping your clients finance ready. This is a great example of doing just that. Okay, now our summary of today is really around doing 3 simple things incredibly well to help your clients with finance, but also to grow your accounting revenue. In summary, the first thing that we often talk around is get good at creating three-way cash flow forecasts. The speedier you can get these done at, and the better the process you have to do them, helps you grow your revenue. But that has a flow through into how quick your clients can actually get their finance applications approved. And I know that that's what really matters to you as accountants out there in the field day in, day out. The second way that we often look to help is by looking at things such as fuel tax credits. Tax planning season is amongst us right now. Look at the depreciation schedules for your clients. What items may go off grid, may go off road, and actually are the clients claiming fuel tax credits and are they aware of them? Refer to the ATO website for exact details. The third way that you can help your clients is the way we've just talked around by way of limits as opposed to one-off transactions. What's the client looking to do? How is the business looking to grow? Is it looking to diversify over the next 12 months? Is it looking to buy new equipment because new technology is coming into their sector and their industry, and get them ready to be able to do that over the next 12 months? Our next webinar is due on the 4th of May. It's May the 4th be with you. So we have to have a webinar that day because we're all a little bit Star Wars fans in this office. It's going to be on tax planning and finance. So how you add value to your clients during tax planning season. And we'll touch upon how we can help PAYG clients as well as business clients in this webinar. It's one not to be missed. I hope today's resonated with you, and I hope that we've given you some ways that you can take some strategies back to your firm. For our existing partners who have joined us, thank you for your time. For the new accountants who haven't actually had a conversation with us yet, I hope you've got some value out of today, and I hope it's resonated with you. We'd love to be able to help any of your clients with finance, be it for equipment, home loans, or indeed business loans. Ensure that Finance House Group is your partner for finance today and for the future. Thank you for joining us today. We look forward to catching up with you soon. Have a wonderful afternoon.